In this presentation, we will enter adjusting entries related to supplies. For more accounting information and accounting courses, visit our website at accountinginstruction.info. So the adjusting entry will be on the end of the month, 131 or 130. 131, which should actually be 131. Let's change this one up here. 131. And it's going to be for the supplies. So before we get into this, we're going to go through our rules and see if we can figure out what's going to happen just based on it being related to supplies and it being an adjusting entry. Note that adjusting entries will not be involving cash, so I can eliminate that. Adjusting entries will typically have one balance sheet account, or more specifically, one asset or liability account, which is not cash. And so that's going to be one of these related to supplies. How about, supplies? So notice that's going to be pretty straightforward, and that typically is the case. We're going to say that's probably one of them that we will be dealing with here. There's going to be one income statement account below the blue line, below the light blue, in the dark blue in the income statement related to supplies. And if we look through that, we say, how about supplies expense? So pretty straightforward, and we know that supplies expense are expense accounts. They all have debit balances. They typically only go up in one direction, up in the debit direction. So we know we're going to debit supplies. It's going to go up in the debit direction. That's what expenses do. So I'm going to copy that. I'm going to put that up top. We're going to put that here in C8, right click and paste. 1, 2, 3. We know if we're going to debit that one and there are only two accounts involved, the credit then will go to supplies. So this one must be the credit. I'm going to copy that, right click and copy, put that on the bottom in C9, right click and paste. 1, 2, 3, then we'll indent, home tab, alignment, increase indenting. So again, we can know all that just by knowing that it's an adjusting entry related to supplies and applying the rules related to adjusting entries. Now we'll see why it is we're doing what we're doing. So we're saying that supplies on hand are 5,000. So what does that mean? What's going on here? Oftentimes it's helpful for us to try to determine, what is this number of supplies? How did it get there in the first place? And why are we adjusting it then? So how did it get there? Well, at some point we paid cash, or we purchased something on account, crediting cash or accounts payable, and we debited supplies rather than debiting supplies expense. So when we bought it, we didn't expense it. In other words, we put it on the books as an asset. Why? Because we haven't yet consumed it, and according to the matching principle, we need to expense it at the time of consumption, not the time of purchase. So that means that now we're trying to figure out, well, how much did we use? And it's kind of like inventory. So we can think of supplies as our introduction to inventory. So if we had 16,000 worth of supplies, we could think of a stacked up in the corner, 16,000 boxes of supplies worth of stuff. And now we're saying that we did a physical count as of the end of the time period, and there's only 5,000 boxes worth of supply stuff left. Then the difference is what we consumed. And again, you might say, well, maybe someone stole it, maybe someone lost it. True. But the assumption is that it was consumed, and we'll have to account for things like stolen stuff and loss and spoilage by accounting for it a little bit better, right? We'll have to figure out other ways that we can determine whether something was lost. One just being what's the average of what should be used over this time period. So in any case, that's our adjusting entry, and it's similar to a periodic method of inventory accounting. So what we need to do then is going to be a subtraction problem. We're going to take the 16,000 on the books, this number, subtract it from the physical count that's still left according to our eyeballs that we counted, 5,000, and that means we need to reduce this 16,000 by 11,000 in order to get it to the physical count that we counted with our eyeballs, 11,000. Now that's a little bit simplified note. This is typical to a book problem for adjusting entries, but just note that, of course, when we counted the supplies and we said there's 5,000 of supplies, we really mean $5,000 worth of supplies. And we didn't count dollars worth of supplies, we counted boxes of supplies. So there's a conversion problem, in other words, between units, boxes of supplies, and dollars, how much they're worth. And if they're all worth the same amount, great, but obviously things change over time in terms of dollar amount. So that gets into cost flow methods like FIFO, LIFO, average cost, specific identification. So we'll talk more about that in inventory. But just note for now, we just know that, this is what we had. This is what we had in terms of purchases, and that's for sure because that's what we paid for it. And we counted and determined the dollars worth that we have left in some format, and that's going to be here. The difference then is what we need to bring this down by, and it's also the expense that we have consumed in some way. Hopefully we used it in order to help generate revenue. It's possible we lost some of it or some of it was stolen. Okay, so we're going to have the expense being the same number. I'm going to do that with a negative of this number. And then we'll post that not to the GL but to our nice little worksheet here and see what happens. So once we do this, we want to see if it does, of course, what we think it should. What do we think it should do? It should bring this 16,000 down to the physical count of 5,000. It should bring the expenses up by the 11, which would bring net income down. So we're going to post first this supplies expense. Here it is on the journal entry. Here it is down here in supplies expense. We're in the middle column. We are in I-24. We will say equals. Scroll back up. We want to pick up that 11,000. I'm going to scroll back down before I hit enter and just say what's going to happen. It's going to increase this 11 hopefully, put us out of balance, and bring net income down. So there we have it. The 11,000 out of balance, net income's down. Notice the effect on net income here. Usually net income often goes down with the adjusting entry process. So it's a lot of times if someone's not expecting that outcome, it can be a kind of a shock that we have to do these adjusting entries to be in a proper accrual basis. And we were at 19,006 before, now we're at 7,600 because we have to report the fact that we consumed these supplies and we consumed this insurance. Then we're going to go up top. Now there are some adjusting entries that will increase revenue as well. So it could be that income goes up, but oftentimes revenue goes down due to the adjusting entry process. Okay, so now we're going to go to this side. We're going to be posting this supplies to the asset account in I7 equals this 11, and that's going to bring the 16,000 down by 11 to 5,000. Remember, that's kind of our check figure. That's what we expected to happen. That's the physical count. That's what we wanted to be at. If that didn't go to 5,000, in other words, we'd probably have a problem. So the effect here is that one balance sheet account's affected. Supplies goes down to what is actually left at this point in time, given our count. And we know that the expense went up for what we have consumed. And that brings net income down, net income calculated by revenue minus expenses. For more accounting information and accounting courses, visit our website at accountinginstruction.info.